admit that I find it most interesting. The title is defining because discipline in 21 looked very, very different. Some of my co-panelists here, which I'll introduce shortly, we have seen passing the 100 consumer tech round at 40x multiple in 21. We have looked at discipline in 24, which was very different. Uh, which is writing smaller checks. Discipline in 26, from where I sit across the table every week, looks very different. Today, I've seen people, the funds walking away from the clean asset because the exit part can't be written down on one slide. So, we have all seen 25 was a record year. We have seen over $60 billion deployed, fundraising all-time high. Yet in Feb this year, exits dropped. Purely data base is 93% year on year. That paradox, plenty of capital, genuine conviction on India, investment committee saying no more often than what we have seen in a decade is exactly what we are here to unpack. With me today, we have Sushma Kaushik, who heads the innovation fund at L&T, bringing a corporate venture lens to this discussion. We have Vishal Verma, investment director, Oman India Fund. Uh, we have Ritesh Chandra, managing partner at Avendus Future Leaders Funds. We have Vijay Dhanuka, MD and co-head of Motilal Oswal Alternatives. Uh, four different investors, four different perspectives. We will try to get their expert advice and views on all these aspects. So let's just get into it. Thank you, guys. Thank you, gents, everyone, to join this session today. Let me start with, what is getting a deal approved internally today? What's really changed in 21? If I have to just do a comparison, what some of us have seen is a good growth story. We have seen a branded co-investor was often enough for an IC to say that, please, let's just go ahead. In 26, what is the single most thing, according to you guys, which has changed the investment committee approving a deal? Sushma, would you like to go for it?
Sure, thanks. Thanks so much, IVCA, for having me here today. And Siddharth, it's a pleasure to be speaking to you about this. I would like to throw a little color on how corporates are looking at investing in this ecosystem, right? And we are not a regular private equity fund. We don't invest out of a fund structure. We invest out of the balance sheet. And hence, the nature of our lens when we evaluate deals is slightly different, right? We invest purely for financial outcomes. However, the rationale for a corporate to get into something like this is more to build the ecosystem, because we see that the technology ecosystem is slightly broken. Also to build supply chains, strengthen supply chains, which in turn will strengthen the business. And of course, the third is to make financial returns or create an alpha in the process. And hence, when we apply these three filters while evaluating deals, for us, we look at deals very carefully. The way we do diligences are very, very different from how we have seen in the private equity universe. And if you were to ask me, how is the IC looking at doing deals now in this environment? We've been investing for the last 4-5 years. It's slightly different. There's a slightly more cautious approach, while fully recognizing that, there are macro tailwinds when it comes to government capex, especially in industries where L&T focuses on, right, which is largely EPC in construction, power, new age businesses, which we have incubated, which is semiconductor, data center, electronics. These are all very, very large opportunities, and we are seeing significant tailwinds. Added to this, we are seeing huge government capex, right? Last year, we saw an announcement of about 11.1 lakh crores, and that's only increasing. And all these are kind of very supportive of the kind of businesses that L&T focuses on. But when we look at investments in technology businesses, we are not looking at proof of concepts anymore, right? We are not willing to take that risk. What we are willing to take is more execution risk. And hence, while yes, there is a lot of capital, there is a lot of appetite, we see strong order books, growth, capex spends, and yet there is a sense of caution, mainly driven by the global, situation, macroeconomic situation. We are also cautious about how there could be order book disruptions, delays, and delays in our case can set us back by a few quarters, right? So, and hence, when we evaluate these kind of opportunities, we need to put on that lens, and hence we tend to be a little more conservative than probably what a private equity investor would do.
Understood. Understood. Vishal, why don't I come to you? What's your minimum viable conviction today? One number, one theme, one founder trait that you believe matters before anything else matters.
Good afternoon to everyone who's attending this event. Thank you, Siddharth, for asking this question, and to IVCA for inviting me over here. And frankly, it's never one trait, right? But at the end of the day, today, what we are looking for is fundamentally strong businesses, right? And when I say fundamentally strong businesses, it includes multiple factors. It includes, something, there has to be a competitive moat. See, OIJIF is a mid-market PE fund. We look at about 5 to 7 years of holding period. We do minority shareholding. We actually like founders to be in majority. And when we do that, we are planning to have an exit either through an IPO over a period of time, or maybe through a secondary transaction. But in order to do that, we try to kind of look at some kind of sustainable growth over a period of 10 to 15 years, because at a time when you are trying to exit, the next set of investors have to be equally excited about the business prospect. So
Right.
Sustainable competitive advantage is a very, very important factor for us.
Yeah.
The unit economics, the evolution of a unit economics has to be settled. We really don't get into anything where the unit economics is still evolving. We are okay to take certain, a diversification risk. For example, somebody could be a city champion or a regional champion. We are okay to back them as a growth capital to be national, or is looking at export-oriented businesses. Then how can you diversify into multiple products or multiple geographies? So yes, we are looking at good ROC businesses with strong operating cash flows. And usually, when we are a single check investor, right? So we try to solve for the next 3 to 4 years of growth using our money and the internal accruals of the company. So, today, as we look at it, a high cash burn business is not something that, we are aggressively looking at.
Right.
So good internal operating cash flows with our money coming in, next 3 to 4 years of capital flows sorted, good ROC. These are the factors that we are currently looking at.
Understood. Ritesh, just taking the conversation to forward to other aspect of deal, in FLF's mandate, from what I understand, is explicitly indifferent between primary and secondary investments. In a market where sellers are or promoters are very inflexible on the valuation for primary, do you believe, in your experience, does the secondary route sort of open doors that the investors are being shut out of?
Thanks for that. Good to be on this panel, and good afternoon to everybody. See, I think there is a very unique dynamic that's playing out in India at this point in time. While theoretically what you are arguing is absolutely correct, that a market like this where primary opportunities are pricing is becoming volatile, secondary opportunities should be more prominent. The challenge is that we are seeing promoters now control secondary pricing as well. Okay, and that is becoming a bit of a bottleneck in closing secondary transactions out. So even though people may be willing, there may be willing sellers, willing buyers, promoters are kind of saying that, listen, hey, it'll disrupt my price, etc. So just hold on to that benchmarking, and that's a very unique trait in India, because normally secondaries should be fairly far more deeper than that. If in most cases, actually, in a couple of cases that we've seen recently, that's certainly been the case. The other challenge that's happening is that what promoters are now trying to do is optimize pricing by doing a combination of primary and secondary.
Yeah.
So what they are doing is that they are, let's say if the business is worth 100, they basically want the primary to come in at 120, 125, and the secondary can come in at 80
Yeah.
odd. Now
Yeah.
that distorts pricing the architecture of pricing completely.
Right.
As a fund, we are indifferent to both. As a fund, we have the flex to do both primary and secondary. But honestly, we are not Santa Claus here to come and put in a primary pricing for the sake of doing it. And that's kind of holding us back a little bit. But structurally, we are quite independent of looking at a primary versus a secondary opportunity.
Right. Right. Vijay, let me ask you this, that, we are also seeing a little bit of strategic shift from a minority to a strategic investors. A lot of private equity investors are inclined towards control deals. What is your take, Motilal's take on this strategy? Are you guys doing a lot more secondary or a substantial minority, or as compared to traditional minority investments?
Yeah, sure. Thank you, IVCA, for having me first on the show. It's a pleasure. And thank you to all the co-participants as well. Uh, uh, Siddharth, our take on we have largely been a growth capital minority investor where we largely back the promoter, and we have not done too many strategic situations in the past. Even today, so I think all the funds are moving in that direction for the simple reason that there is lack of depth in the Indian private equity market. Funds have raised more and more amounts of money, but as minority investor, you find it difficult to deploy that kind of money. And
Right.
second factor for doing that is that you are not able to influence the promoter or the company's outcome if you are a minority investor. That's a broader
Right.
perception. But
Right.
having said that, what we are seeing is that the Indian promoters are becoming more and more appreciative of the values and of the contribution that private equity funds are making. So what we have been doing is we continue to be growth capital investors, but we are also taking majority positions in some of our assets with the promoters still being around. So there are three steps. You can say minority investor, then control deals with promoters being around, and then absolute control deals where you set up the entire management team. We are
Right.
right now somewhere in between. We have done almost three transactions now where we have taken control deals with promoters being around. And going forward, maybe we will selectively do buyouts as well. But our experience of doing buyouts is that India is a very complex market. It's the promoters who really understand the space who have been doing that business for the last 25, 30 years. So
Right.
just by bringing in an entirely new management in a business, it is, I mean, the success is not guaranteed. There are actually more if you look at the whole number of transactions that have happened, there are more failure stories than success stories. So we
Right.
want to play that game very carefully. There is a hell lot of value of the promoter experience. We want to continue backing the promoters and definitely have the promoters around for a long period of time, even if we have to get into a situation like that. So for us,
Right.
right now, it is control deal with promoters, but yes, selectively we are open to testing buyouts as well.
Understood. Understood.
And
So,
another reason for buyouts, if you see again, I mean, we as a country, we follow everything that happens in the West. If you see, buyouts globally have been more successful because of leverage, right? Indian
right.
markets still don't allow leverage, although a lot of funds are now figuring out ways to do leverage. So unless you can do leverage, unless you are able to find the right management team,
Right.
the chances of a buyout failure in my mind is more than the chances of a buyout success.
Understood. Understood. No, so you made a interesting point, and I think you are quite right. And we have seen a number of transactions in India where the control was taken over by the private equity players, and the management was appointed, and there was a little bit of struggle with the new management because obviously there's a new person who has to take control, etc., and get a sense of the customers in consumer business are used to a particular set of promoter and the way he manages it, and the relationship building, etc., takes a little bit of time. So I completely agree there with you. So we spoke a little bit about what are the factors of deal making. But let's also, I just also want to talk about what, a lot of walkaway is happening. Investors are walking away. A lot of deals are falling between LOI and the consummation in this market. So the more interesting question that people are asking in the market is that, yeah, obviously we all know which deals are happening, but which deals are not happening and why are those deals not happening? So would love to get a perspective without, of course, naming anyone. One deal that maybe, you guys have passed in last 6 months and any specific reason that kind of killed that deal by the IC. I don't know, Ritesh, if you want to take that.
Yeah, I think, see, there are two or three things that are changing very dramatically. The first and foremost is there's been a massive technology disruption. So anything, if you're looking at the tech space, right, everything and anything is getting challenged by potentially AI systems across. And you've
Right.
seen that manifest in the public market valuations, which have kind of corrected very significantly for IT and tech stocks. Now, how do you assess whether a business is AI proof or not, and how do you take that call? Just to give you an example, SaaS valuations till last year were anywhere between 15 to 20 times revenue. They've now fallen down to between 6 to 8 times revenue, right?
Right.
You had TCS, which was trading at 7 to 8 times earnings, P, right, at some point in time, right? So the market is actually extremely uncertain in terms of how this will play out. And that's causing a massive disruption in valuations. Now, in such a situation where and this is even before the geopolitical issues started.
Right.
The geopolitical issues have had their own impact. They'll have first derivative and second derivative impacts, which are likely to play out in the next 6 months or so. The reality is, if you do not price that in today, right, you're shortchanging your investors, right? Promoters, I have always maintained, work with the 6 month lag on valuations when the market are coming down, and with the 6 month lead when the markets are going up. So you always have to budget for promoter expectations to come down. I think as investors, when we are investing for several years altogether, we've got to take a call on what is the stable state multiple that's likely to happen. So in our cases, now gone back to decadal multiples, seen what happened during COVID, seen what happened during 2008, 2009, and then taking a call on what sectors to do that. I think the one question that you did allude to, and clearly a lot of deals are today falling on valuation because uh, expectations have not got reset as to reflect reality, both on the geopolitical side as well as on the technology side. And I think that's causing a disruption in the market, and that's what's causing slowing down deal flow. Uh, it's not slowing, sorry, I shouldn't say deal flow, it's slowing down deal closure. Deal
Right.
flows, capital requirement still continues to be there, I think. And that's, at least from our perspective, we are very, very cognizant about how we expect second derivative and third derivative impacts of the geopolitical situation to play out over the next 6 to 9 months. And we are pricing it in every offer that we are making today. As simple as
Right.
that. And we're very
Right.
happy to stay out of the market in case pricing doesn't match. Because honestly, it's harakiri to do a bad deal. I mean, it's okay to miss a good one, but it's harakiri to do a bad one.
Understood. Right. So Ritesh, you made a very interesting point. So Vijay, why don't I ask this to you? The Vijay mentioned about the bid-ask spread, right? The valuation mismatch which is happening. I think the promoters are still holding on to 21, 23 valuation, where the buyers now are much more disciplined, which is one of the theses of our discussion today. You feel that, given a long spread and the requirement that the company needs capital, do you think the promoters are somewhere accepting this, or do you think that even the promoters are happy to wait out? Like Ritesh said, as a fund, they are obviously not going to compromise. They are going to go with a discipline in mind. And if it means there is no deal, we are happy to wait out rather than do a deal at a valuation which they believe as a fund the company doesn't deserve. So what's Vijay, your take on that? You think the sellers are in the verge of accepting it out of pressure, or they are still in a phase of waiting out, in your experience?
Sure. So, honestly speaking, if you ask me, Siddharth, I don't think a lot of deals are falling off due to valuations. Actually, we as investors are to blame for this, all that is happening, because of the way we are running transactions, because of the way bankers are running the deals. It's very different from how transaction making used to happen, say, 10 years back. Today, investors don't want to do their complete diligence work before term sheet, right? Everyone thinks, let's put our hat in the ring, let's issue a LOI, let's issue a term sheet, we will be there, and then we will do our work after the term sheet, and then we will discuss the valuation at that point of time. I have seen this again and again, and even bankers, what they are trying to do is, there is this concept of taking investors to first round, second round, third round, and all that, which was never there 10 years back, right? They are taking 3 to 4 investors to the second round to protect the deal, that if one investor backs out, what happens? So actually the whole conduct has changed. We as investors, we are very particular. We don't issue a term sheet till such time as we have not done our work fully, we are not fully convinced that we want to back this asset at such and such price. I can tell you that so far in our history of 20 years, we have done 56 deals and 57 term sheets we have issued. So there is only one case where after term sheet our deal fell off. Okay. So I think we as investors need to take full responsibility of this, do our full diligence. I can give you one example. There's a company, I'll not name it, where a deal is going on right now. Bankers told us that it has got some 17 term sheets. Now, what happens in a situation like this where you have got 17 term sheets? Every investor thinks, including us, what we did is, okay, the ask is top dollar, let's put top dollar valuation on the table. We'll see later on kya hota hai, right? Because at the end of it, there's only one investor who's going to bite the bullet and who's going to invest. At that point of time, you don't have answer. So I think we need to change this. We need to change the discipline. All investors, including us, we need to complete all our work before issuing a term sheet. We need to be disciplined about the price that we are ready to pay with a plus minus 10% buffer, and not run transaction the other way, the way transactions are being run. Till such time as this practice is continuing, I can assure you, you will see this. You will continue to see deals falling off like this, left, right, center.
Understood. Understood. That's a very interesting perspective, Vijay, that you bring on the table. Sushma, let me ask you this. As a CVC, you have your own versions of walkaway, where a technology is genuinely exciting, but the business model doesn't work, right? Is that tension getting harder or easier for you to navigate as a deep tech valuation reset?
No, that's an excellent question. And if you'd asked me this question about maybe 3, 4 years ago, my answer would probably have been a little different, right? So again, technology is evolving so rapidly that for us to even take a 5-year call is becoming very, very hard. And most of the tech opportunities that we get, and we are not restricted to just Indian opportunities, right? We also get to see a lot of global opportunities as well. And, technology in Israel is far more advanced, European technology in electronics, far more advanced. And then when we see technology in India, the state of readiness they are in and the valuation ask, there suddenly seems to be a significant mismatch, right? And most of the technology developers in India tend to be early stage. They haven't even seen a full gestation of implementation cycles. And hence, most of them are in POC stages, so to say. So they are slightly subscale. But the valuation ask seems to be like as if they are a growing enterprise with enterprise solutions and implementations. And hence, the big challenge we are facing is, taking a technology risk versus a business model risk. We're kind of moving away from technology risks, which we used to take earlier, and moving more towards, underwriting the business model itself. And the challenge we are seeing is most of the technology we are evaluating has not demonstrated business model settling down, right? So someone alluded to unit economics. We are not seeing unit economics take shape or form here. And hence, that is the reason why we have walked away from, we've seen about close to a dozen deals and just not getting the conviction there.
Understood. Vishal, why don't I come to you on this? You have one couple of your portfolio companies exit of Stanley Lifestyles and Prince Pipes has done amazingly well. It's extremely successful. exit. So businesses with clean governance, strong promoter track records, would these companies pass your current entry diligence bar today? What really has changed in today's market?
No, I think fundamentally the businesses, the thesis that we've developed in both of these companies are very long term, right? So, they both are very different approaches. While the investment things are very different, so Stanley is a very secular, multi-decade growth story, looking at market expansion, clean governance, good promoter. That's a very different consumption story. Prince Pipes is a little bit of a cyclical play on how the sector themes kind of play out. So from both perspectives, at any given point of time, there is fundamental growth which is there over the next 10 to 15 years. So as we look at two, three things. One, of course, is that whether sector has maturity, whether the opportunity of the company has to increase market share, and whether it is possible to kind of do that over the next 10 to 15 years. Irrespective from a business model perspective, the business model is well tested. But yeah, so from all perspectives, most of these businesses still have those qualities which could be looked at even today. Of course, these are both listed now. So, you should continue to have a more longer term view, because when you take a company from private to listed, you do have the flexibility to, live with the company through the journey in such a way that you have the opportunity to work on the business model as a private business in such a way that the cleanup which happens on a quarter to quarter or on a year to year basis till your exit, there will always be issues, but you try to kind of manage those issues, work towards the better governance standards, you work towards better business model, you work towards the right narrative that you can set in the IPO. All of that is not possible when it's already listed. External factors will start impacting when you're a listed business, right? And the stock markets will not be correlated with the fundamental performance. So, those considerations should be kept into play when one looks at especially these two businesses going forward. But yeah, from an opportunity perspective, things haven't changed over the last 5-6 years. If you look at the rules of investing, don't change even over decades. The 80% of what you need to evaluate in a business continues to be the same, whether it's a 2021 or 2026. How disciplined you are as an investor and you stick to those tenets is very important.
Right.
One of the problems that we faced in 2021 was not that how we were looking at a particular business and evaluating. The problem was deal flow. The entire market was moving toward a particular kind of deal flow, and to resist and still find the opportunity that kind of suits your mid-market moderate risk adjusted investing strategy was a challenge, definitely. And of course, in 2025-26, what we've seen is that has normalized. We're seeing a lot of companies kind of now coming in of different tech as well as non-tech, startup as well as mid-market companies who are out there, bankers advising them. So that's a good change in the current context.
Right. So, we spoke about what has changed from 21 to 26. One aspect which I must definitely point out from where I see deals is that few years back, we used to talk about valuation, governance, growth quality, right? In a particular sequence. That, all right, is it a good valuation? Is it a good, yes, it's a tick. It's a good governance, it's a tick. It's a growth equity. But what I have seen today, again, I would love to get your perspective, is that all these three qualities are now collapsed into a single negotiation in this market. I'm not sure if you guys agree with this, and if yes, which one do you think is pulling the rank? And I'm talking about valuation, governance, and growth quality.
I think all this and more. So of course, I completely agree with what Vijay said. See, we spend a lot of time before we issue a term sheet as well, right? And all aspects of the entire journey that we will have with the portfolio company needs to be assessed, first before you start committing towards a transaction. So be it your investment thesis, your rights, your exit strategy, and what are the risks that may entail going forward, whether you can mitigate some of the risks, sometimes you cannot mitigate. Sometimes you do not even know what is going to hit you. Most of
Right.
we kind of look at all scenarios, and some of it you can price it in valuation, some of it you can price in structure.
Right.
But if there's something, not everything can be priced in. Sometimes you have to walk away. So, so for example, we lost one of the transactions where the thesis was right. The valuations, we were quite competitive. But we did mention that, we'll take about 2 months to do diligence, shareholders agreement, and we have 2 weeks of drawdown process, and then we'll invest. And we had done all our diligences. But the
Right.
competing term sheet, the promise was to give the money in 3 weeks without diligence or with maybe a top-up diligence. I don't know what it was in. We had to walk
Right.
away from that. So at the end of the day, what you as an investor is a risk that you are ready to take. So
Right.
be it governance, valuation, and the other things that you said, all put together was always the case. Today is the case. I don't think there was a sequence out there.
So Vishal, let me just ask you a follow on that. So you have been on board of Crompton, MetLife,
Compton, yeah.
solar industries,
Right.
different businesses. Based on the experience that you as a fund take, does the veto matrix change? Are you willing to pay up for a quality, or is discipline now a function of price at any quality? Just a perspective from your side.
See, veto matrix, so I'll tell you what it changes for instead of maybe a price or anything. I think price has no meaning to it, because at the end of the day, the way we look at it is that the veto matrix can be different for different kind of business model, or scale of the business can also change the veto matrix. Because for when you invest in business which are still at a stage where they're evolving in terms of their governance standard, their MI structures, their audit standards, the veto matrix has to be far more engaging
Right.
compared to a business which have crossed some of the initial hurdles and retail a particular size. In the context of their sector, they still may be small, but from the context of the where they are in terms of their own governance structure, if they've reached a particular stage, then the veto matrix can be flexible from our perspective.
Understood.
But as a mid-market business where the founders are in majority and you are in minority, certain strategic directional veto metrics remain constant through and through. I would not like to kind of get into what, but one thing which is beyond veto, which is very, very important, which you can never include in your metrics, is alignment with the founder. There should be on day one, when you are investing, there should be alignment both in terms of what is the direction we'll go together in the next 5 to 7 years. What is the business plan which has been agreed? What is the exit window that we'll first look at? We have done 5 IPOs from our fund too. And one of the reasons why we were able to do 5 IPOs is because in all the cases, we as an investor and the promoters were fully aligned that we want to do an IPO. Because you cannot have just it on paper and then
Absolutely.
at a later stage try to figure out that is there a market, because you will never know if there is a market, right? When you are investing, you have to prepare, you need to have a willingness, and you need to have an alignment. And at the time of your exit horizon, you have to hope that there is a window, and good strong businesses will find an IPO window. Pricing could be different.
Right. Ritesh, let me ask you similar sort of a subset of this question, right? You have of course invested in Lenskart, Jaspay, Bikaji, all category leaders. At that stage, you believe that valuation is it really a debate, or the quality just commands a price? Is the IC job is then just to defend whether the price is defendable at the exit, or you think it's much simpler? Your perspective.
So, look, our thesis is always to invest behind market leaders, and hence the name of the fund. Price can never be ignored. Okay, irrespective, we are in the investing business. We are not in the ownership business. Okay, that distinction has to be very, very clear with everybody. As much as I may like the asset, may be God's gift to mankind, if the price is not making sense, it just doesn't make sense for us to buy that asset. So yes, pricing becomes a challenge. But having said that, in India, top tier assets will always command a premium over their peers, right? So you have
Right.
to factor that in, saying that if it's a market leader, it will probably trade at a 10% odd premium to 10-15% premium to the rest of the street.
Understood.
Having said that, at no point in time can you get the brand value of the asset impede your investment decision.
Right.
So that is a red line you cannot cross.
Absolutely. And clear. Yeah. That's that. Thanks, Ritesh there. Vijay, again, coming to you, your portfolios from Happy Pola to Dairy Classic to Rangrao, very different cash flow portfolios. What does growth quality mean in your diligence checklist? Is it EBITDA to cash conversion, working capital intensity, or something else?
All of it. Growth quality means, first of all, business should be operating in an industry which is a large TAM. Okay. And we like investing in businesses which we feel for the next 10 years can grow upwards of 25% at least, which roughly means 10x in 10 years. Okay. So we definitely want to invest in industries which are growing at a minimum of 10-15%, because only in industries where the growth is 10-15% can the founder grow at 25% plus. Uh, but growth should not come at the expense of profitability, at the expense of being a capital intensive business, at the expense of ROC, at the expense of margin profile, how you are looking at it. See, what happens is, fundamentally, again, we as investors tend to condition our mind in the way of thinking what is relevant to making a deal. So if you want to make a deal, we'll find 100 ways to make a deal. Like till 3 years back, there were situations where people were talking about gross margin multiple. Now, I don't know what does gross margin multiple mean, which means roughly if you are selling a product for 100 rupees and if your gross margin is 75 rupees, you will be super excited and say, okay, it's a 75% gross margin business, which means I'm ready to invest in this business and hence I'll give, say, X multiple on gross margin. But what they were ready to ignore at that point of time is that there was another performance marketing of 50 rupees below that. And that performance marketing was the amount of money that was being spent to get that customer to buy your product. So in our mind, then we would be very clear that the real gross margin of that business is 25 rupees and not 75 rupees.
Right.
Okay. So quality of business and quality of management is of utmost importance to us. Price will come at the last, because price will decide, or valuation will decide, how much delta IRR you will make. But whether in the first place you will make IRR or not, that will be decided by quality of business and quality of management that you are backing.
Understood.
And on quality of business, things like growth, capital intensity of the business, capital efficiency of the business, cash flow, these are non-negotiable for us.
Understood. So that just brings me, Vijay, to the last segment of this discussion, is the exit visibility, right? So exit has dropped, like I said earlier, 93% year on year in Feb, purely on data. And then this number has been there on every LP call this quarter. How is exit visibility reshaping, the exits? The very first conversation you are having with a founder. So why don't I come to you, Sushma? Given that you have a slightly different exit route than a traditional private equity. L&T itself or its ecosystem as a strategic acquirer, I know it's a financial investment, but a strategic angle. In this market where the financial exits are, if I may use that expression, loosely collapsing, does a strategic exit path make you as an investor more patient, or does it have its own complications?
Being a strategic acquirer, we know the challenges of those exits, right? So when we underwrite these kind of investments, the top question on exits are not so much timing. Yes, we don't have the challenge that most funds have, that can we time our exit to certain market conditions, we can wait. But what we do evaluate is the exit eligibility. That is this company even exitable to begin with, right?
Understood.
And when we underwrite at the stage we invest, IPO is a very, very distant dream. So, it's good to have an IPO exit option, but that's not something we underwrite. What we do, however, underwrite as a base case scenario is is this company going to be eligible for an exit by strategics? And if we are not able to come up with 3 names in our process, then that's a walkaway for us.
Understood.
And while people do view L&T as a strategic investor, we are investing completely for different reasons, right? And
Right.
also some of the things that we have seen is when we invest in a company, it's not even a company we would acquire, but we have built a certain ecosystem, a certain business, which is very valuable for someone else or some other type of a business. It could be in the services industry, it could be in engineering, it could be in other domains, right? But for us, that clarity of knowing who that prospective buyer is very critical. Second, what we have also seen is in the pricing, and hence our going in price also becomes very, very critical because we know the kind of money or strategics tend to pay, and they tend to be a little more careful, right? They are not as generous, I would say, as private equity guys, and hence we have to be very, very careful and disciplined in our entry investment pricing itself. So, and that's why it makes it that much more challenging when a CVC is sitting on the cap table. But we ensure that there is exit eligibility created.
Right. So, Ritesh, let me come to you with a similar exit thesis. So, FLF, of course, is structured for multiple exit routes, including secondary sales. In practice, which route, in your opinion, has the clearest line of sight? And has this IFSC gift city secondary route is genuinely viable in your experience?
I think, honestly, as investors, when we get an exit, you take it. Okay, you're not concerned about which modality it's coming through. The challenge that's happening is the twofold, right? And again, while people think public market exits are easier, they aren't that easy because Indian volumes in companies, and I can tell you companies which are $2-3 billion in market cap barely have $1 million of trading a day.
Right.
Right. So it's easy to say public market exits are easy. They aren't easy. You've got to plan that out. I think what we are seeing is emergence of 2 or 3 other asset classes. One is obviously you've got secondary funds who are becoming extremely active in India, and that's opening up a new pool of capital as well.
Right.
The other pool of capital that's opening up for exits for funds is family offices. We're increasingly seeing family offices come and take a bite out directly from funds and approaching funds directly for investments. And that's becoming an interesting optionality. Obviously, as an investor, you have to evaluate timing, exit, probability of deal closure and valuations altogether. But honestly, you take whatever exits you get and whatever modality you get. Gift is still about, I think, emerging. I haven't seen too much action there. Most of the secondary funds who are operating are either India-based or are global funds who are working out of India.
Right. Vishal, again, talking about your Stanley and Price Pipes, multi-bagger IPO exits. But, factually, as of data, there are 144 SEBI-approved companies, right, in the queue as we speak. Market volatility is slowing down execution. Do you still believe IPO as a model is a base case for mid-market assets, or is it a blue sky scenario?
No, absolutely. But see, if you go back and look at what was the IPO market 10 years back, it was very weak, right? We were still trying to find opportunities to exit our companies through an IPO route at that point of time. The market has changed. It has helped us actually go ahead and complete some of those IPOs. And what has changed? The broader domestic investor interest has materially changed. 10 years back, it was predominantly foreign investors who were driving the markets and supporting some of these IPOs. But today, the entire domestic institutional and the retail money which is coming, we fundamentally believe that the IPO markets are consistent and it is available every year. Now, the euphoria around that base case would change from one year to another year, which means that in a base case scenario where your company or your asset is differentiated, a small company, for example, Stanley, another one that we have is Divgi. Divgi, we were able to do a main board IPO with 5x subscription at a 270 crore revenue. It is still continuing. We have did part exit and we have continuing to hold it. It is still doing very well because it is a product which is so differentiated and without any entry with a very high entry barriers. You can actually sleep at peace. So the way we continue to look at is that you have to can you predict or that IPOs will happen? No, but you do plan for it.
Sure.
And when we create a thesis, predominantly a thesis basis on earnings growth, right?
Right.
My IRR should be driven by the earnings growth and not by the multiple valuation multiple that I will get at the time of IPO. It's something that you work towards. Because
Right.
in case if I'm not able to do an IPO, I'll have to do a secondary transaction where I will not get the kind of valuations which an IPO market can give. And see,
Right.
strategic is not something which we really believe can happen in a business like this because promoters very, very emotionally attached to their business, especially if they are in majority. If it happens, it will happen, but that's not something that we believe. So it's either the IPO story or the secondary, and the valuation multiples of value that you can get between the two of them is very different. So you have to build your thesis accordingly such that your base case is protected by the business growth and the earnings growth, and the value unlocking you get through the IPO.
Understood. So Vijay, let me come to you because you have seen like other investors, you have of course seen an IPO success in Parag Milk. You have seen a secondary in Vectors. So in today's market, Vijay, if you had a clean asset, right, and if you had to choose an exit route, which one would you prefer as Motilal and why?
I think there are no direct answers to this because all forms of exit have their own pluses and minuses. IPO sometimes get you a better valuation and a better taxation regime, but at the same time, it is way more time consuming, right? I mean, to kind of run through an effective IPO process, it can take anywhere between 9 months to 12 months at a minimum.
Right.
And then you are exposed to the vulnerability and uncertainty of the capital markets. A
Right.
strategic sale, on the other hand, sometimes may not fetch you the top dollar, but can get you quick outcomes if there is a willing buyer and seller. So I don't think that there are very straight and direct answers to this. It will depend on a combination of capital market situation at that point of time. It will depend on how much tax you want to optimize. It will depend on whether the promoters want to do an IPO or not, whether they are ready for a listing, whether the company is ready for listing in terms of size or not. So it's a combination of various factors. But the way we think about exit is, Siddharth, that at the time of investing, what we feel is just focus on underwriting good assets. If you underwrite good assets, there will always be takers for that, either in the capital market or in the secondary market or a strategic market.
Right.
Asset is good, their exit will not be a challenge. Exit
Right.
only becomes a challenge when your underwriting thesis has not played out, when the asset has not scaled up to your expectation. And that is when, as Ritesh was saying, at that point of time, you as investor, you will try tooth and nail to get an exit in the first place, right?
Right.
And whether it will be an IPO exit or a secondary market or a strategic exit, because beggars are not choosers. So you will have to eventually get the exit. But otherwise, if 8 out of 10 assets are good in your portfolio, they will find a way
Right.
to exit. I mean, there are enough opportunities out there right now. Like, for example, let's say you talked about February. According to me, I'm not worried about that 93% number. One, because it's 1 month number, it doesn't tell anything. Second
Right.
is the capital markets have been low for the last 6 months. We all know that, right? Thanks to what Mr. Trump is doing. But does that eliminate the India story? In our mind, no. I mean, India's story is here to stay. So
Right.
IPOs might get delayed, listings might get delayed, exits might get delayed by 6 to 12 months. But if your assets are doing good, if the fundamentally underlying business is doing good, then you don't need to worry. Exits will happen eventually.
Right, right. So, again, relating to exit, I just wanted to check a couple of more questions, given that I have your time. Uh, LPs, I'm told, are asking a harder DPI questions than a year ago, right? Is that pressure flowing into how you structure deal from day one? I don't know, Ritesh, if you have a thought on this.
See, I think it's important to show DPI. Now, what you cannot uh, do is basically you have an investment horizon as a fund, correct? Now, if your investment horizon is, in our case, for example, is 3.5, 4 years, to expect a liquidity to come in earlier than that is being unfair from if any LP is even asking that query. Having said that, it's extremely important that the portfolio is constructed in a manner and the construction is communicated to the LP community in terms of when they can expect DPI. Okay. DPI is important, don't get me wrong, but it's, to expect it to work like a credit fund where there's liquidity happening every year is not going to happen in a private equity business,
Right.
right? So it's important that communication on construction of the portfolio, timing of exits is communicated and is broadly adhered to. So
Understood.
that's one thing that I think proper communication can solve for.
Right. Just one last bit on the exit. Again, I just want to take a case in public market. So all of us saw IDBI stake sale collapsed this month, where the bids were very short of the reserve price despite significant interest. So is it, in your experience or your knowledge, one-off signal, or is it signal that the public market buyers where they see value? Again, it's just open to all, meaning if any of you have a thought just before we kind of conclude
Look,
our session.
in my view, it's a myth that private market valuations work on a independent track from public markets. Private market valuations do get influenced completely by public market valuations. And I think if people are saying, "Oh, my last round was raised at this kind of a multiple 3 years ago in the private markets," wake up and smell the coffee. I think the world has moved on. I think there is a clear correlation between private market multiples and public market multiples. And I don't want to comment on IDBI's case specifically, but I think a lot of the people are today, when I mentioned the price parallax, it's happening simply because of the fact people are living in valuations which are 2 years ago.
Understood. Sorry, Ritesh, thank you very much for that. I'll, because we are falling short of time, I just want to there are multiple questions that the audience who have joined us on this session, and thank you everyone for joining. But I'll just take couple of their questions which they have for the panel. So I'll take the first one from Kezar, who is an analyst in Everstone Capital. He's asking, in the current environment, are more deals being rejected due to inability to underwrite a credible exit or failure to justify valuation under conservative assumption? And how do you quantitatively stress out both before issuing a final no? Anyone who wants to go for that? It's a question from the participants.
Yeah. Well, there is no one answer to it, but actually the current environment with the IPO markets being a little choppy, the SME IPO markets a little choppy, the deal flow is very strong. So, it's not about, it's a time that, it's the opportunity for us to be more choosy. It gives us the opportunity to actually go for better quality assets and structure the right valuations. So it's not a time where we have to continuously think about what's happening around us, because our exit horizon will be for 4-5 years out from here. If we believe in the India growth story, in the sectoral play and the quality of the assets, it's time to kind of buy and structure our transactions in such a way that your entry pricing is managed well. And see, fundamentally, founders are very practical and very, very aware about their fair value. There's an emotional valuation which is on top of that, which kind of is which changes over a period of time. But any founder who has seen multiple cycles, have seen one or two crises in their life, they know the value of cash infusion in the business. So it's a good year, I would say, to find the right assets and get good valuations for funds.
Understood. Thank you so much. Unfortunately, we'll not be able to take more questions, guys, but we'll try and see if we can separately reach out to you and respond to that, given the paucity of time. We titled this session as a defining investment discipline, and what I'm taking away is the definition itself is in work. Discipline in this market is not a filter you apply at the end. It is showing up in the first conversation with the founder, the first check that you cut, the first negotiations on the governance, your first negotiation of the exit part, all you decide and negotiate on day one. What is clear from where I see is the conversation in discipline is not. It depends on who you ask. Who are you asking? A corporate venture has a different lens. Sovereign-backed mid-market investor has a different lens. A late-stage secondary has a different lens. A growth equity consumer specialist has a different lens. So each drawing the line from a different place for different reasons. So diversity of approach is exactly what the Indian private equity ecosystem needs right now. Thank you, Sushma, Vishal, Ritesh, Vijay, for this exceptionally candid hour. Thank you, IVCA, for convening us, and thank you, everyone, for spending the last hour with us.
Thank you, everybody.
Thank you.
Thanks,
Thank you,
everyone.
everyone.
For your time.
Thanks,
Appreciate
for
Siddharth.
having us.
Bye.
Thank you. Take care, everyone.